Markets have a personality. Actually, two. Meet the eternal rivals, the bull and the bear. These aren't just animals on Wall Street. They represent optimism and pessimism that drive every market trend. But here's the real secret. Markets don't move just because of numbers. They move because of people. And people are emotional. In this video, we'll explore how these two personalities shape the market, how emotions like greed and fear affect your decisions, and how you can stay rational when everyone else is losing their head. Let's start with the bull. A bull market happens when prices are climbing steadily, investors are confident, optimism is high, and risk-taking feels almost safe. Think of it like a party where everyone's invited, and no one believes the music will stop. During bull phases, stocks trend upward. News headlines are glowing. More people jump into the market, even those who never cared before. But here's the emotional bias at play: overconfidence. In bull markets, investors start to believe they can't lose. They stop asking, "Is this price justified?" and instead ask, "How fast can I get in before I miss out?" This herd mentality fuels even higher prices, until reality eventually sets in. Now meet the bear. A bear market is when prices are falling, sometimes sharply. Fear takes over. Suddenly, the same companies that looked amazing 6 months ago now look risky. People sell just to avoid further losses. During bear phases, stock indexes decline 20% or more. Headlines are filled with doom and gloom. Even long-term investors start to panic. The emotional bias here is loss aversion. Research shows losing money feels about twice as painful as making money feels good. So, people make emotional decisions. They sell at the worst possible time. But remember, bear markets don't last forever. They often set the stage for the next bull run. Both market types, bull and bear, reveal how human nature drives financial decisions. Here's what happens. In bull markets, greed pushes prices too high. In bear markets, fear pushes prices too low. Smart investors understand these emotions, but don't get caught up in them. They ask, "Is this stock worth its price? Or am I just afraid of missing out? Am I selling because of real fundamentals, or because everyone else is panicking?" Learning to spot these emotions in yourself is just as important as analyzing financial charts. If you can stay calm, you'll see opportunities others miss. So how do you protect yourself from market mood swings? Stick to your plan. If you have a long-term strategy, don't let short-term emotions derail it. Diversify. Spread your investments so you're not dependent on one stock or sector. Stay informed, but filter the noise. Not every headline deserves a reaction. Learn to love bear markets. They often offer great buying opportunities for disciplined investors. Remember, markets will always have bulls and bears. The question is, will you be a calm observer or part of the stampede? By understanding market personalities, and your own, you're already ahead of most investors. In our next video, we'll go even deeper into how market psychology affects timing and strategy. Don't forget to like this video, share it with a friend who needs clarity, and subscribe so you don't miss the next episode in this Share Market Basics to Advance series. See you next time, and remember, stay rational, stay invested, and let the markets work for you.